It takes us to our talk of the tape. The road ahead for your money as the markets make their way through this turbulent week. Let's welcome in Anastasia Amoroso, iCapital's chief investment strategist, with me here at Post 9. It's good to see you. Welcome back. So what are we to make of what's transpired this week?
Well, today, the stocks are struggling to hold on to any gains. And I think, Scott, the reason for that, this is such a low conviction market because we don't seem to have conviction as a market in the economy. And we've got initial jobless claims that are coming up tomorrow. I feel like people are waiting for that with bated breath. And it seems like in the beginning of the week, the recession fears were on. Today in the morning, they were off, but maybe they're back again. So I think that's why we're likely to chop around while we try to sort out the data. You know, the other thing, when you have drops like we've seen on Monday, you look to technicals. And what we know from the technical setup is that this is a very thin liquidity market. You look at the market depth, it's something like 63% below the last 20-day average. So, you know, you got uncertainty, you got bad liquidity, bad depth, bad seasonality. By the way, the S&P is now trading, I think, 52.15, which is below the 3-month average. And none of that is good because that drives systematic selling.
There were some who suggested this was mostly positioning. You know, we had the unwind of the carry trade, and that was Monday's conversation. It's sort of mixed in with the concerns about the economy, which is so interesting because last week, as the Fed chair spoke on Wednesday, he sounded pretty sanguine about where the economy was and where the labor market was. Said it was just normalizing. Then we got this jobs report, and everybody kind of had a panic attack over where the economy truly is.
Well, it was the payrolls report on top of the SOM rule that has been so frequently discussed and debated, I would say, and that's what really spooked the markets. And Scott, the market, I mean, going into July, where we're talking about this potential disconnect that's building between the economy and the market expectations. And look, the economic data has been surprising to the downside for quite some time. The labor market has been surprising to the downside, and yet the markets had to catch up with that. So I would argue that maybe some of the unwind has been just positioning driven, but I think we now have a catalyst, which is watching the payrolls data. The reason why markets pay so much attention to payrolls because that's what the Fed chair essentially created as a new yardstick for the markets to watch, the labor market and what they will do after that.
There's a feeling today, at least in some corners of Wall Street, Tony Pasquarello, Goldman Sachs, for example, saying it's not the start of a new trend. This could be just one report. Don't take your eye off the overall market ball. Now, don't step in with 2 feet because, as you said, maybe the unsettling feeling of all this has a little bit more room to go. But do you look at the market and you say there's opportunity to be had, or are you just kind of stepping away and letting things settle?
Well, a couple of points here. First of all, I talk about the low conviction in the market, but our conviction is that we're not headed for a recession, and I'm still in the soft landing camp. And I don't think the data that we've been getting is actually recessionary. I mean, one data point that sort of flew under the radar was the one on Monday where the ISM services number, the employment actually increased. That indicator has increased. So that's different than what we've seen in the payrolls report. So that maybe suggests that the payroll miss that we've seen is a one-off. We do know immigration contributed to the unemployment rate. We know that the new entrants in the labor force drove it higher. So, and then, of course, you look at the Atlanta Fed GDP, we're looking at 2.9% for this quarter. So I'm still in the soft landing camp. And so that brings me to the second point, which is I do think there are opportunities to be had in this market. I don't think it's a quick snapback because we're going to be looking to build conviction in the economy. But I do think you start to step in and you buy certain pockets of the market.
Yeah, but you're looking kind of defensive, right? Utilities, munis.
That's part of it. And, you know, I think Tony talks about it in his note, you know, sort of looking in both directions. And I think that's exactly what I'm doing as well. I am looking to defensives and like utilities, because if this economy is slowing, not even if it's going into the recession, if the economy is slowing, you want to be looking to defensive sectors. If the Fed is cutting interest rates, historically, it's the defensives that actually outperformed in the 3 months after that. So that's why that has to be part of the barbell. But, Scott, I've also been tempted this week by semiconductors because the valuations are now not quite to the lows that we've seen over the past year, but getting pretty close.